I'm Jeremy Wall. I am the co-founder and CEO at GoalMakers. And in just the fewest words that I can, we'll jump right into the presentation. The goal of this is to talk about a few of the financial metrics that oftentimes, as business owners and operators, we overlook. And the goal here today is just to chat about a few of those core ones and how we kind of think about those. GoalMakers, what we do is we're a virtual business coaching firm. We've created an 8-week, we like to think of it as a micro accelerator, 8-week program that facilitates coaching just to make this type of session a more regular process in your business. Today, we're going to have kind of 3 buckets that we're going to cover. The first is going to be income statements and balance sheets. We need these in order to calculate the financial ratios, which is going to be the second. We'll just look through 15 of those kind of traditional financial ratios that are very much widespread, but oftentimes we don't know how to calculate these or even what they are or why we calculate them as business owners and operators. And then we'll go into 3 of those that I specifically like, 3.5. 3.5 of those that I specifically think that we like to put a little bit more of a microscope on those specific metrics. And really, I think starting out, this is one of my favorite lines to open this with, because the idea is that oftentimes we think that as business owners and operators, someone else is just going to run the numbers. And really, I think at the end of the day, that becomes this default of, oh, well, yeah, I've got a CFO, I've got an accountant, I've got a bookkeeper. But as the founder, the CEO, as a manager of even an individual department, I think it's part of your job, no matter what. Just because these are things that you should be watching, especially as a founder or C-suite. These are things that everyone should be aware of and should be brought up in regular meetings, just to make sure you're tracking those. And I say them again, metrics that matter. And so fundamentally, we believe that every employee should have access to this knowledge. And at GoalMakers, we like to think about our program as a street smart MBA. And we think that when everyone from the sweeper on the factory floor to the CEO, no matter what size the organization, understands this information and the importance of it, it's going to inform your decision-making process. And so really just from a why perspective of tracking these metrics, that's why every decision becomes smarter when you're following this. So starting with the income statement, I mean, this really is kind of like business finance 101. And the income statement is a snapshot of a period of time. And so when we say that, you can make an income statement for the year. That's traditionally how it's done. You could even make an income statement for the month, or even the day, or even an hour. Traditionally, it is not worth the time or effort to make it for an hour, but it can be worth it for specific quarters or something where you really want to just look at how can we get granular, especially if you're in a seasonal business. Often a year-to-year timeline allows you to see how the business is tracking over time. And so I like this term here, that putting multiple years together allows you to see how that's tracking, where you're trending, but one income statement alone is almost like a single point on a ruler. You don't know what direction you're moving, if you're going up or down, until you do year over year. And so then the second part of this, and this is something that, again, these terms are very business finance 101, but the top line, your revenues can continue to go up, but the bottom line, and we often hear, oh yeah, focus on the bottom line. The bottom line comes from an income statement. And so that is your net profit after taxes is where we like to think about net profit being the number you should watch. Revenue is great. Sales are awesome. We always want to have momentum on that. But this number, you can actually grow yourself out of business if you're not watching the bottom line down here. And so I pulled this one in because every company, no matter how big you are, you can be worth $2 trillion like Apple. You have the same exact numbers. It's the same lines of an income statement, no matter how big you are, whether you're Apple or you're a small mom and pop operation. And we're actually going to use a little bit of a case study today. And so Vala Rock and Tile is the case study that we like to use. And here are 3 years of income statements from this company. And again, you can see it's the same lines. We've added a couple more, and instead of just the sales, we're looking at COGS, cost of goods sold. And so as you track all these numbers, you can see revenues is going up year over year, almost 3.5 million, up over 4 million, up over 5 million. But if you come down here at the bottom, and I know it's a little crunch here at the bottom, the net profit goes down. And so this is something that as you look at these different lines, you start to understand where that could happen, where that can happen. I mean, salaries, as you grow a bigger team, that helps that revenue go up, but your net profit can drop because you have a bigger burden on expenses, even if your sales are growing. And so this is where we say, focus on the bottom line. A lot of people get excited. We have new sales, new sales, new sales. If you don't focus on this line and you take your eye off the ball, you can grow yourself out of business. The second half of this is the balance sheet. And so the balance sheet is a holistic look at the business. And when we talk about this, this is also a term that some people say, oh, it's a balance sheet. The whole concept is that it has to balance the top and the bottom. It is liabilities plus equity equal your assets. It's a pretty simple overall calculation. And this is the life cycle of your business, but your assets and your liabilities plus your net worth, or as they like to call it in Canada, your shareholders' equity, those need to balance. And sometimes they don't, and that's an actual large problem because it means there's something fundamentally wrong. And then one of the other things to keep in mind is current versus fixed. So when we talk about current, those are items on this sheet that are going to be turned into cash or could easily be turned into cash within a year. Fixed very likely could never be turned into cash. So property falls under fixed assets, where inventory falls under current assets. And so when you structure this, you look at the most liquid at the top. Cash is always the top of this because cash is cash. Securities, those are the next one because those are CDs or kind of bank statements that you could turn into cash. Maybe you take a penalty to convert it to cash, but that can happen quickly. And then accounts receivable. These are something we will revisit accounts receivable in the not so distant future. Promises that people are going to pay you. Again, we're using Apple here. This is a company that is $2 trillion in value, but it doesn't matter. We all have the same income statements and balance sheets. Coming back to our Voila Rock and Tile example, you can see current assets at the top, fixed assets right under that. Easiest to turn into cash, a lot harder to turn this into cash if it can ever be turned into cash at all. And so this is really, without going too deep in a 15-minute session on balance sheets and income statements, these are fundamental pieces of your business. And if you don't understand these two items first, keep working on it. It'll be okay. But these two documents plus a cash flow statement are really the most important documents that you need in your business to understand. And so once you have those in hand or in place, whether it's your bookkeeper that helps you get those in place, then you can say, okay, I've got these statements. I'm going to understand them. I'm going to watch them. I'm going to monitor them as we go over time. But the next thing that we're going to look at is the financial ratios. And you only need those two documents in order to do this. So financial ratios are universally known by those in finance. Now it's time for you to understand them too. And so again, we started off by saying it's not just the accountant's job. This is something you need to be tracking. So we'll again use this case study, but here is the simple version of this. And if anyone wants just this list, we've got this on a full PDF document. Happy to share that with you. And I'll drop my email in the chat, jeremy@goalmakers.com. If you want any of these, please reach out to me. But there's a few. From the balance sheet alone, you can calculate your current and quick ratios. So how liquid is your company? Say something really happened. These are the kind of things that your bank is going to look at if you say, hey, we need a loan. They're going to ask, what's your current ratio? And if you say, what's a current ratio or what's a quick ratio, you're a lot less likely to get that loan straight out of the gate. Then you look at the ones that come from the income statement. This really starts to look at profitability for your business. And again, this can be created in income statement for even a quarter. So how profitable were you in Q1, Q2, Q3, Q4? That's a very different thing, especially if you have a seasonal business. And then as we look at general and current financial ratios, I mean, you're looking at sales to assets, return on investment, inventory turnover, inventory turn days. These are just more of the general ratios that you need to be able to track. And one of the big things that we like to talk about here is that you should set goals. And if the name of our company, GoalMakers, doesn't kind of insinuate that, you're not tracking kind of how important we think this is. But knowing these items allows you to set realistic goals and allows you to say, we need to bring this in. One example is a company that we've worked with. We helped them understand accounts receivable. And once they had their accounts receivable calculated and turned it into days, we'll revisit this in a second, they realized they were at 60 days on their accounts receivable. They set a goal for in the next year to bring that down to 45 days. That put $180,000 back in their cash flows at the end of the year. And that's huge. I mean, it also helps you stop bad debt, but really these are things that we not only want to track for the year, but set goals to reach that. And so they're different for every company, every business, every stage of business, and every industry is going to have different kind of standards of what that is. But we want to make sure you understand them. You want to know how to use them and calculate them from your own financial statements, and then create those goals so that you have a realistic but ambitious goal for how you're going to improve your business year over year. And so we're going to do a quick deep dive into just 3 of these. Traditionally, if we're in person or virtually live, this is going to be forcing you to actually calculate them based off the case study. But because we're in a 15-minute session, I'll kind of run through them a little more quickly. The current ratio we brought up earlier, this is something your bank's going to look at. An investor, if you're trying to raise money, is going to say, okay, if something went down or something hit the fan, how quickly could we turn assets in our company to pay short-term obligations, specifically those current, again, means within a year usually, and how can we maximize the assets on our balance sheet to satisfy our debt or any other payables? So to calculate the 2017 current ratio, that's this column right here, it is a very simple calculation. You're going to take your current assets and divide it by your current liabilities. And all you need is your balance sheet to do this. Where are those numbers? Right there. So current assets for this business, $1,443,811. You divide that by your current total liabilities, and that is going to give you a number of 2.6 to 1. So again, understanding how to calculate it is very important, but understanding what that means is very different. And so this is where we're now going to say, let's turn this into a sentence. For every dollar of current liabilities, we have $2.60 in current assets. And overall, that's actually a pretty good ratio for your current ratio. One of the things that is you look at a little bit deeper, and this is where we talked about the reason you should understand this is being able to set goals for yourself. And so accounts receivable is one that often people overlook. This is how easily and effectively are you collecting the money that people owe you. And so this one actually requires both the balance sheet and the income statement. We're calculating just for that 2017 number, but sales divided by accounts receivable. This is one of the ones that I really think that often we overlook in business, especially if you're a product business or a service business. You need to be able to find these numbers. So you're grabbing the sales and you're dividing by the accounts receivable. Those numbers right here on the income statement, your sales are right there at the top, and accounts receivable is its own line. Once you divide that, your AR turnover ratio is 7.3 to 1. However, if you don't know actually what that means in context, it's very hard to actually determine what do you do with that information. So if you could turn that into a sentence, good luck. But this is where we then use account receivable days. So you take that same ratio you just calculated and you look at how many times your receivables are converted into cash within a given period. So you could do that for a full year, a quarter, or even a monthly basis. And so we would take that 365 and we divide by the account receivable turnover that we just calculated. That gives us 7.278 was our number. So sorry, that is that number here. Accounts receivable days is 50. So 365 divided by 7.3 is around 50. If you make that into a sentence, on average, it takes us 50 days to collect our accounts receivable. And so kind of coming back a little bit, you got this 7.3 number, revenues for the entire year divided by accounts receivable for the entire year. You divided those by 365. And on average, it takes us 50 days to collect our accounts receivable. Every business is different. You might have different kind of discounts. That's a whole different conversation, discounts on how quickly people pay you. But really one other thing to highlight is on average. And so you could have one massive client that's 80% of your business and they could pay you quickly, but if everyone else takes 60 days, you really need to watch out for averages. But this is, again, these are metrics that matter. You need to track these things. And finally, ROI, what is the return on your investment in terms of if you're looking at to calculate a return in terms of dividends and payouts, This is calculated as a percentage. And so net profit before tax divided by net worth. I love the term shareholders equity over net worth because it's a little bit more tangible as business owners. We don't really use it here in the States, but you take those two numbers, net profit before taxes at the bottom of your income statement, you divide by your total shareholders equity. These are right at the bottom of those, 21%. So you take that 2.214 number, turn it into a percentage, and then now making that into a sentence, if anyone has a shot at it, for every dollar I put into this company in 2017, I got 21 cents back. So does that make sense? You're looking at 21% return on your investment, but you're getting 21 cents back on top of that dollar. And so just in short, key takeaways for this, your current ratio can vary drastically from different industries. It depends on how liquid the assets you have are. But one thing to think about is if the current ratio is considered high, maybe you're not using your cash effectively enough. Having more cash on hand is not necessarily a better thing, because you might not be putting it to work and managing your capital. And then if the current ratio is too low, then if you had a run and someone said, hey, we need our payments tomorrow, you're in a bit of a hole in terms of being able to hit that. Accounts receivable, if it's too high, then your AR department has taken too long to get that money from people who owe you money. And a low receivables means that maybe you're not giving credit to the customers who are viable for that and are going to be a better partner and buy larger amounts if you give them better credit ratios. And so look at these, beware of averages, but track these over time. And finally, return on investment. It's easy to calculate, it's easier to understand, and it's a universal measure of profitability. One thing that ROI doesn't take into account is how long an investment is held. So if you're holding it for a biotech company, you might be in there for 20 years as that goes through FDA trials, whereas a software company and a high growth tech company really trying to raise Series A, Series B, like Pendo here locally, you're going to want to see that in a different context. But overall, that's the end of the presentation. Trying to rush through this is always a little bit fun, but a little bit difficult. And at the end of the day, it's your job to track these trends. It's your job to be able to calculate these. It's not just the accountant's job, but everyone who is educated on this is going to be able to track these and watch it. So at this point, I'm happy to open up to questions. I know we've got a handful of folks here in the room, but if anyone has questions, comments, concerns, thoughts on financial ratios, please, I'd love to hear them.